Inflation worries come back as US CPI comes in hot. Front-end US rates explode, taking stocks down into technical bear market again. VIX spikes as dealers flip back into negative gamma for OPEX this week, but compared to cross-asset vol and credit spreads, it still has room to go. And finally, the ECB doesn't appease Italian bond markets, and fragmentation risk takes the euro lower. All this and more in this week's Macro Insight. Okay, welcome back to Macro Insight, everyone. Today is the 14th of June, and let's take a look at these markets. So last week, another crazy week in markets. And again, all driven by the rate side. You know, time and time again, we're seeing massive moves in rates, and it doesn't seem to want to stop right now. So if we have a look, in terms of sigma adjusted moves, what do we get? A wave of blue again, right? So rates, and this time being led by the US 2-year. So obviously, the big news last week was US CPI coming in hot. That triggered a pretty historic move in 2-year rates and a load of hikes coming back on the table, basically, in terms of US rate pricing. Yeah, ECB were also marginally hawkish, as were RBA. And the combination of all those things had kind of got the market starting to front run the CPI on Thursday. And then obviously once we got the print, it just kind of carried on and melted down basically in terms of bonds and equities. So obviously stocks took a decent hit with Europe and the US down around 7 to 8% last week. But China managed to still hold on to some small gains because it was up so much to start with. But it did have a big reversal from those highs. And kind of came off in short order after we got news of more COVID lockdowns around sort of Shanghai, Beijing sort of area. So it looks like those guys are still pretty determined to shoot themselves in the foot and not really kind of reopen properly by the looks of it, right? So, and that may well be ongoing. If they're not going to drop the zero COVID policy, then you're going to get these stops and starts kind of happening for God knows how long, probably another 6 to 12 months. What else was going on? In credit markets, we saw credit spreads blow out, widened to levels not seen since May 2020. European sovereign spreads also blowing out after the ECB meeting, gave no firm details on their fragmentation crisis tool that I mentioned last week. All words, no substance. Markets decided to test them to make them come out with some substance, basically. And that often is what happens, right? They try and jawbone it, market calls bullshit, and they have to give us something more concrete, basically, right? So you saw pretty dramatic moves in Euro and Bund BTP spreads, and that is likely to persist until we get something firmer out of the ECB as to what exactly they're going to do. Yeah. But we did get the rate hikes that we were expecting because inflation's kind of running away in Europe. So confirming that we're going to get hikes in July and September. In terms of commodities, remaining pretty mixed with oil and gold firm last week at least. But then copper hit obviously on the China U-turn. So industrial metals taking a hit, uranium taking a hit, that sort of thing. Oil's still holding up pretty well, but gold got whacked yesterday and reversed about 2 to 3%. So not managing to hold on to its gains as real yields continue to spike. And then finally, crypto continues its sell-off as the capitulation really starts to gather steam. All sorts of things coming out of the woodwork in crypto, but we'll talk about that a bit later in Crypto Insight. Okay, so those are the major sort of market moves and what happened last week in terms of market action. If we then drill down in a bit more detail, look at kind of the hikes that are, you know, being priced back into the market. You know, what sort of moves did we see? So we saw about 60 basis point repricing in 2-year US rates, which is pretty aggressive to happen in like 2 to 3 days, right? It's kind of the biggest swings we've seen in a very long time. The 2-10s yield curve also went back to inversion or close to. It's kind of chopping around near that sort of zero level. 5s, 30s actually did go negative again. If you look at the sort of rate hikes that are being priced in now, you know, we're talking about 7 last check, probably even higher now by September. And June, i.e. Wednesday's meeting, is now being priced for 75 basis points. So all of a sudden, even after Powell saying 75 basis points isn't really appropriate, they kind of seem to have leaked it that they need to do 75. And kind of a couple of banks last week started calling for it, and now JP Morgan weighed in after an FT, I think it was a Wall Street Journal article, and pretty much the whole street's now in line with 75 bips. So as long as it's not a surprise to the market, they're going to do 75 bips, right? They'd kind of be a bit mad not to. If they're trying to get a hold of inflation expectations, which are kind of becoming unanchored, and now the market has repriced them to 75, if they didn't deliver 75, that would actually be a shock. And it'd be a dovish shock, which they probably don't want, right? So I think we can fairly safely say that 75 bips is our base case now, basically for Wednesday. That's what seems to be being priced by the market, and I wouldn't really fight against that pricing, to be honest. The rates market kind of knows what's going on, and then the chart in the bottom. Chart on the bottom right just kind of shows you the Nasdaq futures superimposed with the inverted 10-year yields. And just shows, they have kind of been moving together again. Obviously, there was a small breakdown in that correlation a few weeks back as growth concerns came on, but very much inflation back in the driving seat, taking tech down, and that catch up in equities to the downside that I said could happen, right? Last week, we were talking about, are we going to get this catch down, in the S&P and stocks in line with rates? And that's kind of exactly what we got as rates took out those highs, basically, right? And that correlation flipped back to positive. Yeah. The other data point really that is kind of spooking people and sort of equities a bit as well is confident consumer sentiment, right? Absolutely destroyed, right? To lowest levels on the record of this measure, basically, right? So that's pretty dire. And usually that's some sort of leading indicator of growth and consumer spending and stuff like that. So clearly not a good sign. And then a large part of the reason is because inflation expectations are flying. So we can see the 5 to 10 year. So we're not talking about 1 year inflation expectations. 5 to 10 year inflation expectations are as high as levels we've seen since sort of 2008, right? So that is the problem, right? That's what they really need to get control of. And what they're concerned about kind of losing grip of is those long run inflation expectations, okay? So we kind of touched 4,200 like a week ago. We were up there. I'd kind of flagged that range 4,200 on the top side and 4,075 on the downside. If that broke, we were probably going to slide and we were going to retest 3,800. That pretty much happened in a matter of 2 days. A bit quicker than I anticipated as well. We're kind of there now at 3,800, but we've broken it. The question is, can we stay below it, right? If we were to get a weekly close below it, that would probably be a bit more bearish. But obviously, we've got plenty of action to come tomorrow with the FOMC. And then we've also got Bank of Japan later this week, which is becoming more and more important, I believe. Yeah. In terms of just sort of longer term support levels, that 3,800 break opens up the way for 3,540. And then below that, I see 3,200, right? So now who knows how quickly these sort of moves can happen, but that swift move down has been pretty violent. So I wouldn't be overly surprised to get in the vicinity of that next support, even in the next week or two. Yeah. Now it did feel like the market just kind of needed an excuse to start selling again, right? Because everyone kind of felt that it was a bear market rally. They just didn't know how long it was going to persist. And, CPI kind of gave us that excuse, right? Obviously, banks are calling for a 75 basis point hike, but it's kind of expected now. Is that really going to make the market accelerate to the downside? Not clear. Some had hoped that we might get a bit of calm before OPEX this week, before the next bout of volatility, but no such luck, right? Once we broke away from sort of 4,000, then it all hell kind of broke loose. Yeah. Now I think some option players like the likes of Sam Carson had been talking about potential pinning for June. I think that ship has sailed, right? There doesn't seem to be any pinning anymore, right? We've broken away from any hope of that. So I'd expect us to probably remain quite choppy into OPEX. Now, I suspect there's a few other factors also, before we talk about OPEX, a few other factors to consider, right? So you've got the CTA bid gone, right? With the rollover last week, all the momentum signals have rolled over. So there's no CTA buying coming from momentum signals, no systematic buyers there. We had talked about vol control were going to be buying because realized vol was coming down. That's also kind of gone, right? Realized vol is kind of starting to pop again. CTA, commodity trading advisors, but basically think of it as a as an acronym for systematic traders that have like trend following momentum type strategies, right? That's kind of the term used to describe CTAs. Okay, so that bid's gone, vol control's gone. Corporate buybacks, that's obviously been a marginal buyer. They were apparently very, very active on Friday, according to Goldman's buyback desk, and yet the market got nailed still, right? So they didn't really stop the market from free falling. And corporate buybacks are going to go into blackout from sort of starting tomorrow to middle of June, right? Ahead of the next earnings season. So as the corporate buybacks go into blackout, that takes a bit of a bid away from the market. So it opens up a bit of fragility in terms of spot because there's less people on the bid side, basically, right? So that's something to be aware of, I would say, in terms of, you know, what we could see into the end of June and ahead of Q2 earnings. You may also get like downgrades starting to come through in anticipation of Q2 earnings as well, because we know they're very inflated. So quite a few reasons to be a bit bearish over the next few weeks, I would say. Yeah. If we then sort of talk a bit about sort of vol space, the VVIX collapsing and the VIX kind of coiling in that range, right? So you see these red bars, they were getting smaller and smaller, kind of wedging, kind of coiling into a range in that sort of 24, 25 area. And we knew there was a lot of open interest in the VIX complex expiring on Wednesday. And the move in the VVIX, which is the green line that got crushed down to like 80s, that was signaling that dealers in the VIX complex were long VIX vol and they were dumping it basically. Okay. And then finally, because we got enough of a move down in S&P and it was a pretty dramatic move, the VIX finally got a reason to rally, right? And we can see as we broke away from that concentration of strikes, we've now caught a bit, you know, started to move a lot more basically, right? And the VVIX that was in 88 range has spiked up to sort of 112, right? 112, 113. So that's quite a nice catch up in the VVIX, right? Which kind of suggests that now we're away from that concentration of VIX strikes. Things are a bit freer to move. So both the VIX can move and the market. I mean, the market has already managed to move anyway, but I just think with dealer gamma, and you look at the bottom chart, which is kind of Brent's, you know, gamma profile, dealer gamma looks pretty negative. Price action's confirming that, certainly into Friday. So that's kind of where we are now. I suspect that, yes, the street, it looks like 3,700 area. There's a decent amount of gamma open interest on 37 area, basically, that I think rolls off at the end of this week. So dealers are probably short that, okay? But we know that the dealers are probably long the 36 area via this JP Morgan collar that expires at the end of June, basically, right? That put spread collar. And I think that what we might find is whilst the street short gamma here, and we're going to be choppy into Friday, once that short goes away, if the market is still in the vicinity of that 3,600 area, the street's going to find itself quite long vol. Okay. So you might get this situation where actually markets have a period of calm where they stabilize in that 3,600 area for a bit because dealers are now long that strike. Yeah. So unless there's a replenishing, unless you get a lot of rolling of options where dealers get taken back out of a load of fresh downside, and even if they do, that fresh downside is probably going to be lower strikes, right? Like 3,400 and even below maybe, then you might have this situation for a couple of weeks where dealers own the 3,600 area. We get loads of bearish fundamental news coming through. Markets continue to drip down, but they don't explode down. They kind of trade down more orderly into the end of June, basically. I could definitely see a scenario where that might happen, basically, right? So something to watch out for. But between now and Friday, no reason to expect any kind of pinning. I would expect some pretty wild gyrations in this market. So yeah, I wouldn't be like, you know, I wouldn't want to be short gamma right now into Friday, basically. Yeah, this chart here. So we said the ECB was one of the main events last week, right? And whilst they came out hawkish and we got a little knee-jerk reaction higher in euro, I mean, it lasted about 5 minutes, right? And then you just got the big risk that we were talking about, which was peripheral spreads starting to blow out. So the charts at the top kind of show you Italian government bonds, BTP 10-year hitting 4%. First time since, well, it's higher than 2018 levels now, which is worrying to say the least. The chart on the right is the actual spread versus bunds. So you can see the bund BTP spread has blown out. Before the meeting, it was around 2%. It blown out to 237 now. That's the trade that Alf Pegatiello has been talking about that he's got on. Seems to be working beautifully. So yeah, that thing, who knows where it goes, right? But they're going to test the ECB's resolve, right? They're going to keep taking these things wider until they actually do something concrete or say something concrete, right? So they're kind of going to force their hand to some extent. So I wouldn't expect these things to pull back in any meaningful way until we get something firm out of them. Yeah. Now, once we get something firm out of them, these things might come crashing back down, right? So there is some event risk there you need to be aware of. But for now, wait and see. If you look at the price of euro, obviously it sort of touched near 108 and now it's pretty damn close to 103, which was the support, 103, 103.5, where it bounced off earlier in May. If that level breaks, if that 103 level breaks, which it may well do if these spreads keep widening, then parity is obviously a bit of a psychological level. But below that, on the long-term chart, you got to be eyeing up sort of 0.9 really as a major long-term support area that we may slide to, right? So we could get quite a lot of volatility still in euro. The put skew in euro has started to go bid, as you'll see when I send out the dashboard. And yeah, I mean, vol's a bit bid, but really skew starting to go a bit more bid to the downside there, basically, right? As the euro risk is kind of increasing. Yeah. Had been pretty boring for quite a while, had a little bit of action recently, had a spike post CPI. So we were at about 1840, spiked to like 1880 on Friday. And as usual, flopped back down again, basically. Gets everyone excited. This is it. And then, no, sorry, off that. Yeah. And I mean, the easiest way to explain that is the dollar ripping higher. In the face of the dollar ripping higher and real yields ripping higher, it's very hard for gold to rally, right? So really, it just can't escape that gravity, right? So you see the chart on the top right, that's real yields inverted. That's collapsed to about 60 basis points or rallied to 60 basis points, but obviously the chart's upside down. And that's going to make it very hard for gold to rally, right? There's a lot of people out there, a lot of macro guys out there who like gold. They like it longer term. But you can't ignore the price action. And this is something that me and Tony discussed, right? Like, respect the tape. Like, the name of the episode coming out Friday is called Respect the Tape, right? He's a very big advocate of looking at price action, letting that confirm your thesis. That's when you get properly excited about a trade. When the price action just cannot do what it's meant to do in the face of what you think are reasonably good fundamentals and news drivers, then you've got to respect the tape. Yeah, and that's what I think on gold. You look at the ETF holdings, pretty stable, hasn't really gone up despite the crypto puke that we're seeing. We had been seeing some negative correlation between crypto and gold sort of over the last year. Crypto's shaved how much? Like 50% plus. Gold's kind of gone nowhere, right? So that seems to have gone away, that sort of negative correlation aspect and that move away from crypto into gold, right? And that's it really. So, I mean, I flagged on the vol dashboard, I thought gold was heavy. That was before the spike, right? But if you didn't have any on and you were able to use that spike to get into some put spreads, which I was talking about, then well done, right? Because that was a trade that was looking quite clear to me, right? That you should use, the vol was cheap. I didn't think gold was going to escape the kind of liquidation type move. So that's not a bad setup for gold put spreads, basically. That was the idea. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.